Okay, let's answer some questions from the last market outlook. So many good ones. What I've been doing lately is just taking a subset of the questions and answering like four or five of them in more detail, but there are so many good ones. A couple of them I will do deeper dives in. If you want to follow along, all I've done was go to the video directly, and the order that the comments appeared in is the order that I have them here. You should probably find them in the same order. So let's begin here with the rising strength in the dollar. Could you please go over the reasons for a strong dollar, the impact it has on equities and bonds, and what may happen if the dollar weakens in terms of impact on equities and bonds? So the most typical reason why a currency strengthens is because of interest rate differentials. So and here we're really talking about money market to money market. So let's say USD versus, just take any other market. And if you have a money market rate, typically proxied by whatever the effective federal funds rate is or whatever the 3-month is, they'll usually be fairly close. If there is a higher premium here than there is in another market, you will have a strengthening of the currency versus this one. If the expectation is that the let's just say the interest rate in the US versus the interest rate in, we'll just say the foreign market. If this differential is expected to widen, then the US will gain strength in relation to this. We have central banks around the world that have basically been starting their rate cutting cycle, and the belief is that the US is going to hold firm for a while. So the interest rate differential is increasing, which is why the US dollar is strong. Whenever we're looking for a primary reason why a currency is strong, it's usually because of the expectation of where the interest rate differential is going to go. And then it could be other things as well. The idea of tariffs from the US on the rest of the world is also leading to a strengthening of the US dollar, because the thinking is it will hurt the other countries more than it will hurt the US. And the other countries will be forced to lower interest rates because their economy will slow down faster, thereby increasing the interest rate differential. What does this mean for equities? The closest thing you can think of is for the S&P 500, for any company that's international, they presented consolidated statements. So let's think about revenue. You have US dollars, and then you have the translation of all the other currencies into US dollars. So if the US dollar is strong, this translation is lower. So on a US dollar basis, it actually is a drag on revenues. And then you have to translate the balance sheets as well, which could lead to currency translation losses, so that the amount of equity decreases, because that shows up in accumulated other comprehensive income, which is in the equity section. So it is a drag on equities. It's also a drag on exports, because in terms of other currencies, US imports become more and more expensive. As far as bonds, a strong dollar, I think, supports a carry trade. If you think the US dollar is going to strengthen and you can borrow in a country like, let's say, Japan at a very low rate, or in CHF, in Swiss francs at a low rate, and use that for US money market funds, you'll get a higher yield here than here, plus you'll have the appreciation of the US dollar at the same time. While these continue to be weak or even depreciate. That is a great carry trade. On bonds itself, since you have duration risk in there, I don't really know that would attract too much in terms of a currency trade, because now you're taking on currency risk, and you're taking on either duration, or in equities you're taking on beta risk. Finally, one last point on that is the U.S. market is expensive. You're over 22 times earnings right now, and the U.S. dollar is strong. So if we're thinking about Canadian dollars, Not only is a US dollar more expensive, but the US market is getting more expensive. So in Canadian dollar terms, it's a really expensive market to buy. In rupee terms, it's a really expensive market to buy. In yen terms, it's a really expensive market to buy. But if you have US dollars, other markets are a lot cheaper to buy because the US dollar is so strong. So there's a level at which the US dollar begins to work against itself by making other markets more attractive, by making exports really expensive, but by making imports really cheap. So there are some stabilizers in there that would limit the appreciation of the US dollar. The next one is just a comment. We can skip over that. Next one is just a comment as well. 2740 mark of the recent double line roundtable. Macro Outlook Martini Booth, that is D Martini Booth, mentioned that somebody presented a paper on the deflationary effect of deportation. If I had to guess, I'd say it was, no, it wasn't me. Question about open interest. Puts and calls can both be sold to open or bought to open. Hence, how does one know if it is a bullish positioning? Well, the put-call ratio is just the amount of contracts that are open for puts versus the amount of contracts that are open for calls. And you're right, it's hard to know exactly what motivated it. But an option is a contract between a buyer and a seller. So if somebody buys an option, there had to be a seller. Open interest is one. That's how it's calculated. Even though there's two parties to the option, open interest is one. So you can look at how many open puts there are and how many open calls there are. That is put, call, open interest. That's all it is. Well, there could be more sell to open, buy to open. Okay, so that doesn't really matter. Another question, assuming a stock has tons of buy to open calls for January 5, 6, 7, but the stock was at 450 a day or two from expiration with barely any buy to open puts, how true is it that the stock will sell off into expiration? Well, that is for the market to determine. If there is very little action in the options, the market maker is going to stay neutral. The market maker is not there to speculate, so they will delta hedge. And if there is no reason why they need do anything else, they will stay delta hedged because they have to be long the stock because they're short the call. Now, if there's a whole bunch of covering, if there's a whole bunch of closing of the options, let's say all those long call option holders want to close, they would then be selling options of which the market maker would be buying, which means they'd have to sell the underlying. The closing of the options could put selling pressure on the underlying. But if the stock is at 450 and you have calls, long calls at $5 or $6, chances are there's no premium there. It probably would be more expensive for you to close it than to just let it just close on its own. Could you please explain interest rate parity and why a currency with a higher interest rate typically implies a lower forward exchange rate? Well, it depends on whether it's the price or the base. So let's take a spot currency. You will have a price currency and a base currency. So in the market, you'll see something like this, USD CAD. That is a market-based price quote. That is saying that $1, let's say it's 1.4456, that $1 buys this much Canadian. CFAI, if you're used to CFAI, expresses currencies in fractions so you can do math. This is not a fraction, this is a quote. CFAI would present this as CAD over USD. The spot rate is CAD over USD, meaning it's a fraction. This is not a currency quote, it's just a fraction. Meaning 1 USD, the base is always 1. 1 USD buys so much Canadian, that would be 14456. That's the price of a US dollar in Canadian dollar terms. So let's start with putting it in the form of price over base. You have an interest rate. When I say interest rate, let's say that is the 3-month rate on the price currency, and you'll have an interest rate on the base currency. So the forward price over base is the spot price over base multiplied by the ratio of the interest rates, 1 plus the interest rate on the price, days over 360, over 1 plus the interest rate on the base, days over 360. So we can see that if the interest rate and the price currency is above the base currency, this whole term over here is greater than 1. The spot times something greater than 1 means the forward will be greater than the spot if the price currency has an interest rate greater than the base. If it's the other way around, the forward will be at a discount to the spot. So when we say one is at a premium or a discount, it depends on the relationship between the interest rates of the base, the price, and the base. Find the graph historical performance of the S&P. Just use Google. It's a powerful tool. It's this new thing that's out there. It's a search tool, and you can ask it anything you want. You simply have to go to Google and type in S&P 500 historical returns, and you'll get a whole bunch of results out. Some will have charts. It's really cool, kids. I don't know if you've heard of it or not. Google. It's a funny name, but it's a really neat tool. The stat about reporting workers, consumers in 75 to 100 ratio is interesting. It's not my stat. This is the estimate that's given for immigrants, the level of undocumented immigrants in the U.S. I think it's rather high at 75, but okay. Shouldn't this be compared to the equivalent ratio for the U.S. population? Well, the U.S. population, you'd look at participation rate. What are we at? 62.4, 62.6? I think for undocumented immigrants, it should be somewhere around that as well, and possibly adjusted for average wage and spending of deported people compared to average of U.S. Well, no, I wasn't trying to get to some effect on CPI saying, oh, it's going to be worth 0.1 points. The point I'm making is all we're hearing is that if you take an immigrant and you deport them, it's going to add wage inflation. What we're not hearing is that, well, wait a minute, there was some aggregate demand from this. So if you deport them, you also lower aggregate demand. I wasn't making any statement about the relationship between the two, only that let's not forget you're also exporting aggregate demand. At the margin, sure, you're getting rid of a worker, but you're also getting rid of that worker's aggregate demand at the same time. No matter what you think it is, you're still getting rid of some aggregate demand. Deportation issue. If I have a boat that has a bilge pump, pumps 200 gallons per hour, typically pumps 100 gallons an hour and suddenly starts pumping 200 gallons an hour, is that a good thing or a bad thing? Well, it depends on what perspective that you're looking at it from. If your bilge pump is got a capacity of 200 gallons per hour and it's pumping 200 gallons per hour, it's a good thing. You could say, hey, at least my bilge pump is working. Now, if your boat is filling up with more water, I wouldn't blame the bilge pump, saying, oh, bad bilge pump, you're only pumping 200 gallons of water. Well, that's what it was set to pump. There's a bigger problem somewhere else. But thank God the bilge pump's at least working to its capacity. I'd say, well, that's a good thing. It's working to its capacity. It didn't break down, right? Don't you have to account for how much leakage the boat has? Suppose the leakage is over 200 gallons an hour. The boat will eventually sink, even though the rate of pumping out water is. And then it just trails off. I get this sometimes where I don't have a more over here. It just ... But I get your point. I think what you're referencing is through 2024, the first 3 quarters of 2024, deportations were averaging about 66,000 a month. It is possible to deport more. That is, you can deport 100,000 a month. Trump is starting deportations, and we're worried that, oh my God, a bunch of labor is going to leave the country. But you already have 66,000 deportations a month, which means to be wage inflationary to support that argument, you have to have deportations greater than 66,000 a month to start to begin to affect, to make a different effect than what we've already seen. What you might be saying is, what if the amount of incoming increases at the same time? Don't you have to account for that? I believe he is trying to get the U.S. military positioned across the southern border. trying to get some exception to get the military there. I think border crossings are going to drop significantly. So I guess the other side of your argument is, well, what if he only deports 50,000 a month, but instead of 200,000, a month coming in, there's only 20,000 a month coming in? Wouldn't you have to account for this other 180 that are not showing up? That's a good point. We will have to wait and see what kind of statistics we get, but I get your point, is that we can't just look at one side and what we're pumping out. We have to look at the other side and say, well, hang on a minute now. If we go from 200 to 20,000, there's 180 that's not coming in. So even though you're 16,000 less over here, you're 180 less over here. Good point. That is a good point. Sharing how you do note-taking and how you keep track of the vast amounts of information. That doesn't flow very well. First part of the question, how reliable are bank forecasts? They're as reliable as any forecast of the future. The future, it's not like the future is difficult to forecast. The future is unknowable. And there are times where forecasts today can create the very future you're forecasting, or can avoid the very future you're forecasting. If every economist started forecasting an imminent decline to the U.S. economy, it may spur policymakers into action to start stimulus programs ahead of any of that fall, thereby avoiding the very thing they predicted. So the future is unknowable and it's creatable. Nobody has any skill really at forecasting the future. It is all it's everyone's best guess. Some people have more informed guesses than others, but they are just guesses. And you're giving a list of what January 2024 was, and most of them were way off. If you have somebody saying, where's the market going to end in the year, and you have a whole bunch of people guessing, and you have a whole range of possibilities, let's say 7,200 down to 4,500, well, the market will finish somewhere. And oh, you were right, let's interview you. Well, if the market finished over here, oh, you were right, let's interview you. If it finished over here, oh, you were right. Somebody is bound to be right with enough guesses. Somebody's bound to be right, but that doesn't mean they have skill. It just means if you have enough guesses, you have a wide enough distribution, somebody somewhere is going to be right. Somebody somewhere is going to be right. That's pure luck. That's all it is. What sign would you look for to determine if your forecast needs adjustment or vice versa? Well, usually when you have your forecasts, they're built off some assumptions about labor force, about the participation rate, about the rate of earnings in GDP, whether they'll increase or decrease, about the earnings multiple, whether it'll expand or contract. And as time goes on, you get news in, and you would say, okay, well, this is below my assumptions, this is above my assumptions. Anything below your assumptions, you'd say, well, I better lower my target. If it comes in above your assumptions, you say, well, I'll raise my target. That is referred to as Bayesian updating. Would you be long copper, gold via miners, or would you go to the material directly? I think I'd prefer the material directly at this point. The miners haven't really performed in 2024 to the extent that the underlying has performed. And a reason for the 450, 718, and 57. The 450 is typically an estimate of what the historical equity risk premium is. So what you do is you take a long time series, maybe 60 years, and you look at the average money market rate and you look at the average capital market rate, usually proxied by a 10-year or 20-year bond. This is usually proxied by a 3-month. And then you look at, over the same period of time, what the equity return was. And you look at the average. Well, how much did the equity market beat the average level over that period of time? That would be considered the premium that historically was paid to be in equities, and you could do the same thing for the 10 years. Since most yield curves spend their time upward sloping, and you have a return series for bonds, usually the equity risk premium over a money market security is higher than the equity risk premium over a 10-year. That's over long periods of time. So this is usually about 450 basis points, and that's why I use the 450. So if you're getting a bond return here of, let's say, 7.18%, and we have a curve that looks more like this right now, it's a small upward sloping curve, so I just used 450 over both, then I would say that if we want our historical payment, if we want to earn the extra 450 basis points for the risk of being in equities over bonds, and risk means for U.S. Treasuries, I'm not talking about price risk, I'm talking about the risk that you'll even get your money back. A company can go bankrupt and equity just loses everything, right? So there is risk. There's more risk in the equity than there is in bonds. That you'd want to be paid the 718 plus your 450. How do you play CAD US? Trading futures or just straight spot? Futures are the better way to go. Futures have carry, negative carry in them. But spot has worse negative carry. If you're trading through IB, and you're setting up a trade, what you're going to be is long CAD and short USD. So if you do 100,000, you will be long 100,000 over here and short, I'll call it 72,000 over here. You will earn a lower rate than the Canadian money market rate. IB will pay you less than what you could. And here you will be charged more than the U.S. money market rate, whereas in the futures, you are getting the intermarket rate. So it is cheaper. You will you will pay less on the U.S. than IB would charge, and you'll get more on the Canadian than IB will give you by using a futures contract. Yes, there will be carry, but there will always be carry with something. Do you believe the CAD could potentially overcome this negative carry and appreciate more? I don't know. That's the question. You could speculate, and then you'd have to think about whether it could overcome the carry. Or you could just hedge and say, well, I'd like to convert some US to Canadian at this rate anyways. Then you don't really care too much about the carry. Have you ever owned Chinese or Hong Kong equities? No, I have not. What's your opinion on going long Chinese tech? Is it worth the risk? I don't know, because I don't look at it. I don't bother with it, so I just don't know. When comparing duration performance versus equity, your assumption was that the 10-year yield would decrease by the same 50-75 as the Fed's rate cut. Since the Fed primarily controls short-term rates and long-term rates depend on factors like inflation expectations, why would the 10-year react equally to the Fed's action? I gave no reason for that. I wasn't even suggesting that would be the outcome. You've had the Fed drop the funds rate by 100 basis points, and you've had the 10-year rise by, I think, 121 basis points. And if they dropped another 50 or 75, all I was saying, well, what if the 10-year did the same thing? 50 or 75, it would still result in an upward sloping curve. That if you thought the 10-year was going to drop by 50 basis points, all I was trying to do was come up with hurdle rates for the S&P, right? So too many times we look at one market and we say, well, what do we think is going to happen to equities, right? Well, if you look at the bond market, you say, well, what do we think is going to happen with bonds? And if you have a prediction, if you say, well, over the course of the year, with a cutting down of regulation, with tariffs probably not being implemented to the level that Trump suggested, you have a freeze on government hiring right now. What's that going to do to the labor market? Because if you look at the jobs report for the last 12 months, government was a big source of job creation, right? So you could argue that we're going to have more disinflationary force than inflationary force. Your forecast for the 10-year might say, I think it's going to drop 50 basis points. Well, if it does, what is the hurdle rate on the S&P 500 that would make you indifferent between taking on equity risk versus being in the 10-year? I was not suggesting that it is going to happen. I was saying, well, what's your forecast? Much as I'm not suggesting the S&P is going to go to 7,000 or 6,000, I was just saying, if it did, what would be your hurdle rate on the S&P such that you would say, oh, thank God I was in equities and not bonds? The more you expect the long end of the curve to come down, for you to outperform in equities, the higher equities would have to go just for you to be indifferent. It's another way of thinking about target prices for the S&P, to start thinking about it in terms of Well, what would be my indifference price if certain things happen? Now, if you're thinking 7,100 on the equity market, I don't think that you can get that without the long end of the curve coming down. If you're one of these people that say, no, we're going to have a 6% 10-year and the market's going to end at 7,100, I would say, oh, ho, ho. Your assumptions are contradictory. I don't see how the market can get elevation with yields going to that level. Go back to 2023. October of 2023, yields did this, S&P did this. Then yields started to come down, S&P started to do this. Beginning of the year, you had a bear steepener on the curve. Equity markets came right down. S&P was down 5%. Small caps were in correction territory. And then you had some relief after CPI on the long end of the curve. If you have a forecast, a strong equity forecast, I don't know that can happen without having some forecast of the long end of the curve coming down. And if the long end of the curve is coming down, that just continually increases the hurdle rate on the S&P because you're going to get duration performance. What's your opinion regarding the U.S. debt limit? I think it's necessary to have a debt limit so that you can have that conversation every 6 months or so. To start to think about, well, what things can we trade off on because of this debt limit? Because we can't continue to keep doing this. But perhaps the debt limit, rather than be a number, should be some percentage of GDP. That would be probably a better conversation to have. Going to register for level 3 this August. Wondering if you still have the same feelings towards the 3 different pathways as you did when you made the video a few months ago. Yes, I do, because it is still the same. It's still the same 2025 content. So yes, I do have the same opinion. When I see the 2026 content in, maybe a couple of weeks, the 2026 content will be out. My opinion may change, but I would not be able to share my opinion until level 3 enrollment opens, which would be mid-May. I see your beta versus duration analysis. You're highlighting the effect of rate cut on the long end of the curve. In 2024, we've seen the Fed funds and 10-year rate can indeed move in opposite directions. Yep, I think I've already answered that. Important point, especially for people that are left-leaning, is regulatory compliance costs are inherently regressive rather than progressive. So less regulation is less costs. That's deflationary. And the presentation in there showed the extent of the cost per household of regulation. $2.2 trillion a year just in regulatory compliance per household. Can you explain the significance of Lennar's Millrose spinoff? What is the impact of the parent company? Well, you're just spinning out something that it owns. So as far as the shareholder goes, they should see no change in the value of their holdings. Lennar would drop by the amount of the spinout, right? And then you would have shares in 2 different entities as opposed to having shares in one. As far as the impact to the parent company, their earnings would be lower to the extent that Millrose contributed to their earnings. When I worked in private equity as an intern, would receive pitches about target companies, and I had to conduct a preliminary analysis. With hindsight, I did very little industry analysis because the data was either non-public or not free. In that situation, it would make sense to conduct a sector study analyzing publicly traded companies for the same overarching sector as a Yes, they all operate in the same industry. They may face different balance sheet constraints in terms of equity versus debt. But as far as a competitive landscape, they would face the same drivers in terms of what drives revenue, what drives costs. They would face the same. Not related to market outlooks. Curious if you thought about providing us with an update on life in Costa Rica. At some point, sure. Sharp fall in Chinese 10-year plus strong GDP. What is your read of this? I don't trust the GDP. And the Bank of China was buying bonds, which would drive up the price. And I don't trust GDP. Next one. If we went through the same exercise beginning in 2024, we won't see the market end with a 20% gain in 2024. I don't know if the market can deviate from fundamentals for a long time, so what makes you think 2025 won't turn out to be another 23 or 24? I don't know. I didn't make any assessment in there about whether it would or wouldn't. I simply just looked at hurdle rates, and then I assigned probabilities. And what I did was, if you noticed, I looked at all the incidents in which you had 2 years over 20%. How many times was the third year going to be over 20% as well? And I think there was only 1 year in which it came close, but the multiple was much lower. That it was rare to have 2 years over 20% to begin with. So that's, with that, you have to weight the probabilities at a lower probability that you would be able to do it again. All of this is subjective, right? There are no hard probabilities where I can put my math up and at the end write QED. And there you go. There's my proof, and it's defensible. They're all of it is subjective. No matter how, Goldman Sachs forecast, subjective. Morgan Stanley, subjective. JP Morgan, everyone's making guesses. Some people are paid $500,000 a year to make guesses. Some people work at home in their basement and they're paid nothing to make guesses. Guess what? They're all just guesses. They're all just guesses. That's all they are. Your guesses end up having power in the number of people you can influence with your guess. So a Goldman Sachs that says, I think it's going to 7,000. If enough people believe and have faith in Goldman Sachs, they will put their money to work, and putting their money to work will push the price up, thereby helping them get to their forecast. So the more power you have in terms of the reach you have, the more influence you have, the more likely your guess can be other people's guesses, and you will get them to act the way you want to. But everything is just a guess. If you go through this at the beginning of every year, in fact, try this. Take 10 stocks at random. Just pull out 10 and do this every month of these 10. So you're going to do it 120 times. And give me a price target at the end of the month for those 10. Give me a price target. And I will allow you to be right about 2%, so that if you say, well, I think this will be 100, if you're 98 to 102, I'd say, okay, you're on the money. And do that every month. Take those 10 at random and every month do that. You'll make 120 guesses. I would say if you're 5 or 6 times where you were right on the money, that would be about it. That would be about it. For the other 115 times, the price will either be way above or way below, outside of that range. We're just guessing. That's all we're doing is and we try to inform our guests by looking at the industry, by looking at what the central bank is doing, by looking at what the cost of money is, by looking at what the market is doing, what the sentiment in the market is doing. We're all trying to get a good feel of as much information as we can, but in the end, it is just a guess. It's just a guess. Everybody's making a guess. That's all it is. Regarding Bitcoin, I'd recommend Sapien's book. While I agree with your point about having it no value, Sapien has an extremely good point. Anything is considered value and valuable as long as enough people believe in it. Well, yeah. I mean, I didn't need to read I don't think you need to read a book for that, and neither do I. I knew that at 15. That something, if enough people believe in something, it has value. If you start learning technical analysis, you will come to that conclusion very quickly. Technical analysis only works if enough people believe in technical analysis. Then it will have value. So for some markets, it's not even worth drawing lines on charts because the amount of technical analysts in that market are very low. So most of it won't work. Whereas in things like Forex, most of Forex traders, 70% trade technically. So you better know technical analysis, not because it's real, not because it would still work if nobody believed in it. Only because everyone believes in it does it work. Much like God. God has no power in the world. Only through belief does God have power in the world, because you will act as if God were real, thereby giving God power in the world. But if no one believed in God, God would have no power in the world. It's the same thing with anything. However, there are some things that are true whether you believe in them or not. Gravity. Can't see it, can't touch it, can't feel it. But if everyone in the world didn't believe in gravity and had no idea of gravity, they'd still fall off the top of the mountain. right? It still exists in reality whether you believe it or not. If you stop believing in the value of gold, guess what? Gold would still have value, because for industrial applications, for industrial use, it has a very clear industrial use. It's not used as much because it's so bloody expensive, but if it got cheaper, it would be used more and more. It still has reality whether you believe it or not. But you don't need to read a book to come to that conclusion, that things have value and reality to the extent that people believe it. Yeah, you could take something completely imaginary and it has reality if enough people believe it, right? Big fan of your market outlook. Please consider a non-professional tier. I did ask you to expand on that because that seems interesting. What do you mean by a non-professional tier? Give me some ideas of what that would look like. Let's see. I want to understand the impact of Trump's executive order about unleashing U.S. energy on inflation. Is it going to have any impact at all? Well, the U.S. doesn't drill for oil. The U.S. government doesn't drill for oil. Private companies do, and private companies have balance sheets and income statements, and they're not going to act against their own self-interest. I don't know that it has much value on its own to convince private companies that they should be producing more oil to drive the price of oil down. And he's very contradictory. He was asked about this. Why would producers do this? Oh, the price of oil won't go down. The price of oil will go up. Well, then how will it lower prices for consumers? Oh, the price of gas will go down at the pumps. It's like, well, you can't say both things. So Trump says things just because what he says is, this is what the win will look like, and then just says it regardless of whether the pathway can get to the win. Trump describes the win. A win would be lower prices at the pump. A win for oil companies would be higher oil prices. So let's just say it. Let's just say it. You'll win, and you'll win, and you'll win, and you'll call me up and you say, please, Mr. President, we're so tired of winning. No more winning. We're tired of winning, like he likes to say. And I think, he's bluster. It's a lot of bluster, and, it's not clear to me how you're going to get private companies to drill. It's not clear to me how the price of oil can go up to incentivize them while the price of gasoline goes down at the pumps and the price of energy gets lower. It's not clear to me how all that gets done. Deportations, what are the aspect of tightening the border and not letting people in? What we analyzed here on the impacts of deportations. If the incoming slows down, would that have a similar impact? Well, it does. If you have a border and you have, like I said earlier, 200,000 people coming in, that's 200,000 people that some of them will get jobs, but all of them will have to eat. They'll get cell phones. Most of them will get cell phones because that's how they communicate through WhatsApp. You'll get some kind of cell phone plan. You got to live somewhere. So all of this will be demand. If you drop that down to 20,000, there's 180,000 people that won't eat, get cell phones, or live somewhere. But there are some people who won't take jobs as well. So it has two effects. There is a supply effect, because if you have a job, you start creating supply for the economy. There is a supply effect, but there is a demand effect as well. I think it would be interesting to see more research on the offsetting effects of the supply versus the demand. I think that would be that would be interesting to see, but I haven't found anything like that. But sure, if you stop people coming in, you limit the growth in the labor force, but you also limit aggregate demand. You also have to realize that, 180,000 people now won't be demanding food, won't be demanding shelter, won't be demanding utilities, won't be demanding cigarettes, beer, food, cell phone services, won't be demanding any of that. What needs to happen for mortgage rates to come down? The 10-year, especially the 10-year, has to come down. Are they only correlated to inflation? Well, the mortgage rates are related to inflation to the extent that inflationary expectations are built up in the 10-year. Past L1, considering L2 applied package, the price will increase by 20 if I don't buy until Tuesday, Wednesday. Well, today's the last day. It increases by 230. Actually, as I explained in the video, if you watch it, L1 and L2 prices will drop by $44. Each of them drop by $44. But the applied level is split into two. So there's applied analysis and applied asset management. So the combined cost over two levels will be $550 as opposed to $320 for the whole thing if you get it by the end of the day. That's a difference of $230. Individual bonds or gilts versus ETFs. Understand that ETFs of long-term bonds are nothing but portfolios of different maturities and durations. The most recent elevated yields may not be captured by an ETF, which could have included those bonds at some point. I'm right to conclude that it's best to buy individual bonds in order to get exposure to 5% yield. I wouldn't buy the on-the-run bonds. The on-the-run bonds tend to have a slight premium, so you'll pay more for them. So every 3 months, the 10-year is issued. When a 10-year is issued, it is called on the run. It is the newest issue. The ones that were issued 3 months ago are called off the run. They will drop by a few basis points. They will actually be cheaper to buy than the on the run. So I would look, if you're buying a 10-year bond, I would look for something that is 9.5 to 9 3/4 years in length. And you'll get a few basis points pickup on buying those 10 years. Behind the risk premium, I've already explained that. For a S&P valuation, the probabilities at one rate cut add up to 110. Oh, probably my mistake on that. What do you mean when you say shorting US dollar beta? I mean, not US dollar beta. I'm saying I would be short US beta, which is either small caps, IWM, or SPY. IWM is my favored for being short US beta right now. People, institutions have been warning about lower equity returns for the next decade a lot. Well, whenever we say people are doing something, you have to think about a span of things, and at the very top you have what are called your perma-bulls, where they're bullish no matter what, and at the bottom you have your perma-bears, which are bearish no matter what. So you can put Ed Yardeni up here, and you could put, I forget his name, little short fellow. Rosenberg, David Rosenberg, little short fella. Sorry, Dave. You could put David Rosenberg down here as a perma bear, and then you have a bunch of people that are bullish, and then some bearish, and then the next year these people are up here, these people are down here. So the churn over here is great. So when you say something like people, institutions have been warning about lower equity returns for the next decade, the ones that have been warning about it may not have been the same people year after year after year. There's a lot of churn in the middle. You could be bullish for a couple of years and then turn bearish. So at any given time, there's that group of people, they say the market's going down, but they tend to be different people from year to year. So let's keep that in mind. But there'll always be people every year that think, okay, well, we've gone too far. What keeps equity prices so high now if the consensus is so clear? Liquidity, still just the amount of liquidity that's out there. There still is a lot of money that was created during the COVID pandemic. That money supply has been coming down for a while. It's beginning to grow again, but there is still a lot of money that needs to find a home. There's also a lot of passive money coming into the market, right? So every 2 weeks, you get a paycheck, and out of that paycheck there's usually some deduction for defined contribution plans, and a lot of people opt just to take ETFs. So every 2 weeks you got money coming into the market, every 2 weeks. So when you have unemployment that's really low, you have the aggregate amount of payrolls which is really high, and if there's a certain amount of that that flows into defined contribution plans, into ETFs. ETFs are agnostic about valuation and price. They don't care what the valuation is. If money flows into the ETF, it buys in proportion to the market cap of everything that's in there. It is agnostic. So it could just be you have way too much money in passive flows. You have aggregate payrolls which are very high, so a lot is flowing into defined contribution plans. And the combination of a lot of excess liquidity that needs a home. Watch your videos on new CFA Level 3 special pathways. Encourage perspective to choose portfolio management. Do you think despite the very first version of private markets, it's still worth choosing for candidates who are interested in buy-side, private capital side? I found that I did the private markets module. All the videos are me. And in going through them, I found that the incremental stuff you learn in level 3, private markets, versus what you already knew in level 1 and level 2 is too small. The incremental amount that's new is too small. It's a big repeat from a lot of stuff we've already seen. What product to get the 4% return you mentioned? 3-month T-bills. US 3-month T-bills. Does the equity risk premium and hurdles apply to TSX as well? You can do it to any market, correct. Saw your analysis as someone who is short beta long duration. I hope it turns out the way you put it. That's the same with me. I'm short beta long duration. One thing I find is a wild card when valuing the market is the earnings growth. IMF put out new forecast for US real GDP of 2.7, up from 2.2. Atlanta Fed now cast 4-quarter GDP coming higher than previous forecast. Could the earnings growth outpace the rise in yields and deliver higher returns, beating the hurdle rate? Yeah, it could, but it almost becomes a ridiculous exercise after a while, right? So when we're thinking about intrinsic value, we're looking at the present value of a series of cash flows. So you have a series of cash flows over time, all the way out to whatever, and then you discount them at some cost of capital or some cost of equity. And if the long end of the curve goes up, the cost of equity goes up, you can say, yeah, but our cash flows will be higher. And then the curve goes higher and say, yeah, but they'll be even higher now. And then this goes higher, yeah, but they'll be even higher now. At some point, you have to say, look, how long can we continue with this, but couldn't cash flow simply go higher argument and outpace the rise? Well, sure it could, but at some point you have to say, okay, well, all we're doing to justify the valuation is we're just waving our hand and saying, oh, but cash flows will be higher. And the curve increases 20 basis points this week. Oh, but cash flows will be higher. Couldn't cash flows be higher? Couldn't cash flow? And you can continue to say that forever because this is the future, and who the hell knows? You can make up anything about the future. And if you get enough people to believe that that future is true, well, then the price can follow. Every 3 months, reality does show up. So you do have to be aware that there is a reality called earnings. And once earnings show up, that's in the books. That's history now. That is reality. So there is some prediction of the future. Is it backed up by reality? And as long as it keeps getting backed up by reality, you can feel confident in the future, which is why earnings seasons are so critical, especially when you're paying over 22 times forward earnings. You want to see that companies are bringing the bacon home, right? I would expect the yields to rise in a hot economy. If the earnings momentum continues into next year, 2025 year in S&P reading as a multiple of 2026 earnings could be much higher. So multiple expansion, sure, or it could be much lower, or it could be the same, right? We're all just making guesses here. I'm curious if the S&P companies reporting this quarter will miss Q1 forecast because of a strong dollar. I haven't seen enough yet to determine whether or not that'll be the case. Just haven't seen enough yet. During his first run, Trump suggested the economy grow 4, 5, 6, 7, 8, 9. Yeah, I expect him to say the same thing. Right now he's saying inflation will go away, unemployment will be really low, the economy will grow incredibly, the U.S. will keep winning on every front. I mean, all he's doing is he's listing what winning looks like, without really thinking through what the process of winning looks like. All his statements are what the win looks like, and stating it as if it's going to happen. This is what the win looks like, and a lot of his wins are just contradictory. Got the applied low before the 15. Want to ask if I should watch previous market outlook videos from previous year. Not really. I think just jump right into where we are. You can go backwards if you want, week by week, but I don't know that there's much value in starting 6 months ago. Please explain, why do you believe that we'll see at least 3 interest rate cuts this year? Because I do believe that inflation is not a problem. I do believe it'll continue to come down. But nothing ever comes straight down. It comes down, then it does this for a while, then it goes down, then it does this, then it goes down. You ever been short a stock? It'll do this, and then it comes up, and it's like, no, 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 okay, good, good. No, 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 okay, good. Right? Well, that's same with inflation. We live in a deflationary backdrop. Technology will push prices down. Now you have a freeze on government hiring. What's the jobs report going to look like, right? I think the Fed will be given permission to cut more than once or twice. I know you love Canada. I hate to remind you of the problems here, but perhaps your thoughts on the political landscape. Smith's dissent on the $37 billion tariffs. She didn't dissent on it. She just didn't want oil and gas included in it because that's Alberta's everything. Alberta would really suffer for the rest of Canada, and she's got a point. The rest of Canada under Trudeau didn't treat Alberta very well. Why should she risk Alberta for the sake of Canada again? Get rid of Trudeau first. So she objected to oil and gas. Possibility of a unity crisis occurring in the next 48 months. Wexit. With Polyev coming in, I don't think you're going to get that. Thoughts on Carney's run for the job? No one's going to look at Carney. Everyone's going to see Liberal. And Canada has had enough of Liberal. And I think the Conservative Party will do a good job as painting Carney, because, of course, he's a greenie, right? As painting him as Trudeau 2.0. They'll do a good job, and nobody's going to want to take that chance. I don't know why Carney, with his reputation, would want to take on this role. He will be, I don't even think he'll be leader of the opposition, to be honest with you. I mean, he'll win it, he'll lose the election massively, then he'll resign from the Liberal Party, and he'll ruin the reputation that he has. Why would he want to do this? There is no following a bad act like Justin Trudeau. He has ruined the Liberal Party. You need a break, a 5, 6, 7 year break, and you need to rebuild. You can't do this. And Chrystia Freeland running? Oh, come on. Read the room. Read the room. No one liked her. No one liked her. She's like the next Kamala Harris. No one liked her. She'll lose. They'll both lose. No matter who does it, they'll lose. At least that's my prediction. I have a deep fear that Carney pulls off enough seats to keep Conservatives at bay with the minority. I'm not seeing that right now. Plus, this is not the U.S., right? Canada's not the U.S. You don't have 2-year election cycles. You got 6 weeks. So you're going to have a leadership conference. The leader will be announced. They'll have to go to Parliament. They'll have to introduce a budget very shortly thereafter because you got to get one out. They will be defeated. An election will be called. You got 6 weeks. It's not enough time for Carney to convince the Canadian population that he's not Justin Trudeau 2.0. It's not enough time to do that. And he can't start doing that now because he's not even a Liberal leader. But the Conservatives can start painting him as Trudeau 2.0 now. So the Conservatives have a long lead time over what Carney can do. Let's see, take the point, but perhaps your equity return predictions are a bit low. Well, we can all agree, this is the whole thing about projecting the future. If I give you a spot curve and I put 10 people in 10 different rooms with a bond, they'll come up with the same price. But if I give you a spot curve and an equity and put 10 people in 10 different rooms, they'll come up with 10 different prices. They'll all have different stories as to how revenue will grow, how cost will evolve, what debt will look like, what equity will look like, what working capital needs. They'll all have different opinions. There is no proof. The only proof you have is waiting. And one of them will be right. One of them will be closest to being right and will think, oh, that person's really good. But somebody's bound to be right with enough forecasts, right? So yeah, without reading the rest of this, if you're saying the predictions are a bit too low, you would have different predictions. That's perfectly fine. That's the equity market. It's a bunch of people that are highly educated to highly uninformed and highly uneducated, making a bunch of guesses about a future that nobody knows. That's the market. That's where trillions of dollars of value are put at stake in guessing an unknowable future. Do you benchmark your own returns to an index? Not really. Not really. Example of a suboptimal equilibrium. Well, tariffs are a good example of a suboptimal equilibrium, because you'll fall into that very easy, and you can do this with a prisoner's dilemma. U.S., rest of world. Tariffs, no tariffs. Tariffs, no tariffs. If the U.S. implements tariffs, what is the best decision the rest of the world can make? Implement tariffs. Because if the U.S. implements tariffs and the rest of the world doesn't, the U.S. wins, the rest of the world would lose. If you felt the U.S. was going to put in tariffs, your best move is to put in tariffs. If the U.S. was not going to put on tariffs, your best bet is to not put on tariffs, right? If the U.S. wasn't going to put on tariffs, you putting on tariffs would win, the U.S. would lose. The U.S. could do better by putting on tariffs. If the U.S. put on tariffs and you did not, you could do better by putting on tariffs. So in the end, you would end up here, tariff, that is a suboptimal equilibrium, because both sides would lose under that scenario. Trade, the amount of trade would drop, the amount of beneficial trade would drop, and would raise costs in both countries, because now you'd have to rely on more costly domestic production or go without. The U.S. has no domestic production of pineapples, well, other than Hawaii, but let's take something else. Let's say mangoes. So if you want mangoes, you're going to pay 25% more at the store, or you're just going to go without mangoes and switch to something else. Everyone loses. So the amount of mangoes being shipped into the U.S. would drop, and consumers would pay more for them. So there is dead weight loss. There is welfare loss associated with that. So that is probably the most easily accessible example of a suboptimal equilibrium. Do you think long-term yields are going up across debt markets to compensate for U.S. government credit risk? Well, let's say that they have credit risk. That is saying that you are doubting the default risk-free. I don't think they have credit risk. They may have credit migration risk. In other words, their credit risk may be downgraded. I don't see how markets can continue to rise with the long end of the curve rising. It will work against it, because the long end of the curve prices the future cash flows. So you get a 100 basis point move on the long end of the curve, unless you can continually keep saying, oh, but cash flows will grow even more. Oh, but cash flows will grow even more. Unless you keep continually saying that to give yourself a level of comfort, it's going to lead to lower present values. Talk about gold being reality. With that, you mean real demand for jewelry? No, I mean reality. I mean, here's a gold bar. Let's see if I can draw this out right. And there's a little glint in the gold bar. Ding! There's a gold bar. Everyone stops believing in gold. I'm sorry, that gold bar's still there. There it is right there. It exists in reality whether you believe it or not. Gravity exists in reality whether you believe it or not. Right? So sharks exist in reality whether you believe it or not. These things exist whether you believe it or not. God only exists in belief. And I made the same thing about Bitcoin. It really only exists in belief. If everyone stopped believing in it, what would it be? It's just an imaginary asset, a string of zeros and ones. You can say, but it has value in what it's being used for. There is some pursuit of owning it, only because there's a belief in it. If nobody believed in Bitcoin, you couldn't just say, oh, hang on a second, there's a Bitcoin there on the ground. But there'd be a penny on the ground, even if you didn't believe in pennies, right? They exist. You look down, hey, there's a coin on the ground. There's a nugget of gold on the ground. There's a diamond on the ground. There's a watch on the ground. Hey, look, there's a Bitcoin over there on the ground. Well, no. No, it only exists in belief. That's all it has, is an exist in belief. Reading about the valuation metrics, want to get your thoughts. Start of 2025, trailing earnings 24.16 above historical norms. Earnings yield still exceeds 10-year treasury yield, but with a much narrower gap. More complete expected return approach factors in the S&P 500's index level, expected earnings growth, cash flows, payout ratios, implying 8.91 expected return and a 4.33 equity risk premium. Do you think this more complete approach is better than relying on PE ratios or earnings yield? Well, you can to do that. Notice what you're doing. You're taking something you can observe today, the index level, and you're saying expected earnings growth. So that's a guess. Expected cash flows, that's a guess. Expected payout ratios, that's a guess. So you get to 8.91. Why not go to 12%? Why not change your guesses and get to 12%? Why not go to 15? Why not go to 20? Right? If you want to make the case that equities are where you want to be, there's no stopping on the expectations that you can come up with. My point in doing what I did was to show the hurdle rate that the equity market would have to hit based on a cash rate that we can see, or a bond yield that we can see. But once you start thinking about the future, if I put 100 people in a room and I say, well, here's my assumptions for how the market gets to 7,000, you'll get 99 people that disagree. One person would say, yeah, that's pretty much right. And the rest would pretty much disagree. You'd have, well, what about this? And what about that? And what about this? And what about that? And this isn't math. There is no proof. There is no proof I get to that says my argument is foolproof. There's nothing you can do. You must accept it, or there's a shortcoming. It's anything you want it to be. So whenever somebody says, but what about this? What about, sure. If that's what you believe, then sure. But keep in mind that you're putting money to work based on what you believe. And if you're comfortable with that, great. That's what makes a market. Do you think the more complete approach is better? Any approach that brings in more could potentially be better. But any approach that brings in more relies on more guesses, which could potentially be worse. Every guess introduces estimation error. So if you need 20 guesses to get to something, you got 20 points of estimation error, right? Conversation about GSE reform. I don't see a question there, but I've seen it. Can you explain a bit about what you think the consequence of this would be for agency market? Nothing. I don't think anything. I don't think anything, because whether it's private or public, the GSEs is not going to change the pace at which homeowners get mortgages. I don't think it's going to do anything there. And Investor Day, they commented they don't see a problem as before, as long as privatization is done as responsible. I agree with that. The problems that existed in 2008 don't exist today. I agree. What are your thoughts on U.S. debt limit being breached? It's a dog and pony show. Dog and pony show. That's all that is. I don't think it really has much value. If there's only 1 or 2 cuts, it would have to be supported by growth in the U.S. economy. True. That would mean increasing earnings and give no reason for multiples to drop. Yeah, well, that's what exactly. You'd have to assume away the downside by saying, oh, there'll still be multiple expansion, or at least the multiple will hold up. Oh, earnings will increase. If even if rates go higher, earnings will increase by even more, and the multiple won't drop. You'd have to assume away everything that would lead to you concluding that equity prices could go down, because you don't know. Again, you see the theme in this video? You don't know. Nobody knows. So to justify higher markets, you'd have to assume those things away. You'd have to assume that no matter what happens, the market will just do even better. No matter what happens to the bond market, all will just grow faster. Discord server, thoughts on Trump meme coin? Ridiculous. But if you told me that the Trump family took an opportunity to self-enrich, I don't think that I'd be sucking in a lot of air. That wouldn't happen. It'd be like, and you expected what? What did you expect to happen? I've made this forecast in other videos. I'll make it here. I predict Trump will leave office as one of the richest men in the world. Level 1 candidate studying financial engineering, will it be useful to me without level 2, 3 knowledge? Yeah, I mean, if you're already studying financial engineering, you're already doing it. You're already learning something. Assigning probabilities SPX based on interest rates seems to contradict assigning probabilities to SPX based on interest rates. I wasn't assigning probabilities to SPX based on interest rates. I was looking at, and I wasn't even predicting. I'm not predicting prices. I'm just looking at a hurdle rate. I'm saying S&P is here. Cash will give you 4.18. So you got to be at least here on the S&P on the price to be indifferent. That's just a hurdle rate. I wasn't forecasting probabilities based on interest rates. I was just saying, well, you got to be here. And then I just said, well, I give about a 30% here. I give 15% here. That's just subjective probabilities. But I wasn't assigning probabilities based on interest rates. Seems to contradict your previous videos where you talk about complexity and nonlinear thinking. What does this have to do with complexity? I think your analysis would be useful from a retrospective angle, in the sense that it could explain past movements, but is not useful for projecting. I wasn't projecting. I'm not following this comment. On that being said, I think you can make a case that given the uncertainty with interest rates, implied volatility is too low. Okay, I can get to that conclusion. Yeah, I think you're right. Given the heightened level of uncertainty we have going forward under Trump, because he likes to surprise the markets, I think you're right. Implied volatility is too low. And several weeks ago, when I talked about major themes for 2025, my number one theme for 2025 was increased volatility. Investing performance. I don't know it all yet because a lot of my money is managed externally. So until I get those reports, I really don't know. Let's see. Where are we now? Okay. 24-minute mark. You talk about how repatriation deports 100% of the demand, but only 75% of the employment. I think this simplifies it too much, forgetting about how immigrants consume much less than they produce. But that's true for every single employee everywhere. Right? Take a $300,000 lawyer. The only reason that lawyer is being paid $300,000 is because their billable hours far exceeds the $300,000. Take a worker being paid $50,000. They're only being paid $50,000 because the contribution they produce is more than $50,000. If the billable hours here were only $200,000, then that would not be employment. That would be charity, right? That statement is true of every single employee everywhere. Maybe not government employees, but true of every single employee everywhere. The point of employment is that you produce more for your employer than you cost. Because if you don't, what do I need you for? You're just a cost. If I pay you $50 and you produce $40,000 of output, I'm sorry, but who are you that I owe you $10,000 a year? No, that's true of everyone. They are underpaid compared to the value they create. So is every employee, right? Due to the big leverage of the employer and also a big percentage of the money they do get is sent home. If they're underpaid and if they have so little and they have to pay to live, how can a big percentage of what they make be sent home? A percentage of what they make is sent home, I'm sure. But I don't know that it's a big percentage. Now, you can say that for the migratory immigrants, the ones that come up to do farming and then they go home. Canada has those as well. What the U.S. is after in particular are the undocumented illegal immigrants. There is legal immigration for farm workers. That legally happens. Canada has a big program of that as well, where there is legal immigration for farm workers. They get temporary permits. They're migratory immigrants. They come in, then they go back. And yes, they do send money home. I don't think that is what's going to be affected. It is the undocumented illegals that are in the country that he wants to get rid of. Also, they work in very few industries like manual agriculture that will be impacted the most. And such, I believe we will see huge inflation in food products that demand manual labor made in the USA, but maybe deflation in things like shaving cream that are cheap and everyday products. the Fed really pays attention to the core. Food prices are stripped out because they're volatile. It's the core that matters. So I think we're good there. This is, we can have different opinions. You believe it'll be inflationary, so you would probably want to be short bonds. And if you think it's going to be inflationary and you're short bonds, you kind of have to be short the U.S. market as well, right? Another question here. I've been thinking about how Gen Z's upbringing, shaped by platforms like Instagram, TikTok, might fundamentally altering their worldview. Exposed to an overwhelming amount of curated wealth, beauty, violence, and hyper-stimulating content, things that were unimaginable for previous generations. So am I, so are you. You don't have to be 20-something to be living online. Most of us live online these days. Most of us have streaming content where the level of violence and gore and graphicness in shows and movies is way more than it was 30 years ago. We all use YouTube. Most of us, a lot of us, are exposed to X, Truth Social, Instagram, Reddit, Discord. I mean, I don't know that this is a 20-something phenomena. This is a every generation phenomena, except maybe once you get into 70, 80, 90, maybe to a lesser degree. But I basically live online, and I'm not unique in that. Violence that even historical figures like Ottoman sultans in their harems could have imagined. I don't know. You see Game of Thrones? The difference is we watch Game of Thrones. People in that time period lived through Game of Thrones. You lived through seeing that kind of savage brutalness. You lived through wars where it wasn't guns or cannons at a distance. It was swords and axes up close. I think that was a lot more brutal than we have today. Constant exposure creates desires that are often unattainable. I don't know. Leaving many feeling disconnected from traditional aspirations. I'm sure you could make that argument that some things set impossible standards to live up to. Yeah. But hasn't sports always done that as well? You're watching hockey, football, basketball, baseball. These are people at the top of their profession. Wasn't that would you say that was an unattainable standard or source of inspiration? So you could say that watching that guy at the gym with a perfect body show you different techniques for developing yourself is presenting an unattainable standard for most men. Or is it an aspiration, something to look up to, a role model, somebody who's showing you how they got there, right? So, nothing is good or bad, only thinking makes it so. So you can think that, these are unattainable standards, or you can think that this is pulling society forward by providing look, I can do it, you can do it. These people exist, the standard exists. Obviously, I can reach that level myself. They may feel cornered like cats with nowhere to go, strike out because they feel they have nothing to lose. And I think that in every group of people, there's going to be the left tail that simply just throws their arms up and says, I'll never get that. I'll never be able to do it. And some of them in recognizing that they'll never be successful or they'll never be rich, also don't want anybody else to be successful or rich, so they say things like tax the rich, without understanding that it's the rich that provide the very context by which they can get jobs and better themselves. What's your take on this unique generational perspective? I don't think it's unique. I think it's every generation. Do you think their exposure and worldview could lead to fundamentally different reactions compared to previous? Well, that is the way of the world. Change is a constant. Will it lead to different reactions compared to previous generations? Sure. Our generation in the 20s had different reactions than the generation before us, which had different generations than the reactions before them. And on and on and on it goes. Sure. But I don't know that I would look at it as just from one side. Look at it from the other side. It is absolutely inspirational sometimes. I know that I watch some things on YouTube, and it makes you want to try harder. It makes you want to be better. I know I watch some of these guys in the gym that are just in perfect mid shape, and they'll show you how to change an exercise just slightly to target a muscle. And then I go downstairs in the gym and I try it, and I think, I kind of like that. I never would have had that kind of curated personal training where I get to pick and choose just by watching without it. I don't see that guy sets a standard that I can't achieve. I'm not trying to achieve that standard. But if I were 25, I would look at that and say, I can look like that. I can do that. Or I may be of the mindset of, I'll never look like that. And that is going to happen to a certain amount of the population, which has always happened to a certain amount of the population, this level of learned helplessness. Trying to predict the movements of TLT, question about your position management. Ooh, look at all the math in this one. I'm not going to do that. August 25th, market outlook, TLT 98.45, interest rates 5.5, Fed funds for July 25. Okay, fast forward today, TLT is 87.20, rates 4.5, July 4.10. Question is, when you have a metric like duration of TLT, say 16 as a multiple, clear that we should be using the expected rate cut rather than the exact rate cut. Okay, I'm not following this right now. Let's get to the question here. With all this in mind, July 2025 magically gets back to 410, the duration multiple of TT at 97.68, lower than the original price with the same effective interest. Oh, okay. What you're not accounting for is convexity. You are thinking in terms of linearity. But when we look at bonds, we have convex pricing. So this is yields down here, and this is price over here, that as yields increase from here, let's say yields increase to here, the price drops from here to here. But not in a linear fashion, in a very convex fashion. So what you'll find with TLT is if you have a 25 basis point advantage on TLT, it should very closely increase by about 4% if its duration is 16. However, the next 25 basis point move would be more than 4% because it would change the duration from 16 to something higher. Let me show you what duration kind of looks like here. And let's see if I can shorten this, and we'll just do a tangent at this line. So duration is approximated by the tangent of that line. And let's say that is negative 16, which is where and this is why we multiply things by negative modified duration, because it is a downward sloping line. Let us now, let's just reduce yields, and I'm just drawing this in roughly, and this would be, you'd have a price increase. So if you then drew a tangent at that line, notice the slope of that line is steeper, which means it has a higher duration. So as yields drop, the duration of TLT increases such that the next 25 basis points would be more than 4%. The next 25 basis points would be more than that, etc., etc. And the higher the price goes, the higher the duration would tend to go. The lower the price goes, the lower the duration, or the less the duration would change by, giving a floor that each 25 basis point increase in rates wouldn't mean the same drop in price. So you're looking at a linear relationship, and you need to look at a convex relationship. By the way, all of this is level 1 fixed income, just to give you an idea of the power of what CFA curriculum can deliver. You learn the relationship between yield and pricing at level 1, and you learn, the big thing you learn here is that convexity relationship, that as yields go higher, the downside gets less and less on the bonds, which makes it a very attractive entry point at high yields, because if yields go down, not only do you get the price move, but you get the price move along with the convexity, and it's that convexity that can give you great returns. Bitcoin. Drill, baby, drill. Melania Trump, Bitcoin, yeah. Assumptions when deporting people is that people employed are providing income for the people who aren't employed. Thus, the net wage inflation, deflation is more about how the okay. Investment for my parents who are senior citizens. Okay, I'm not going to get into any kind of advice at all. Trump talks a lot of shit, but he really doesn't end up doing that much. His posts about going halvesies on TikTok show he's always willing to play ball and keep the cash flowing. I don't think he actually cares about tariffs or deportations. I think he's a good political advisor that know that the crowd wants to hear. Probably. You're categorically wrong on Bitcoin. You can't say that. You can start the sentence with, I disagree with you. But to say I'm categorically wrong means that you have some insight that is perfect. And you don't. You don't know. You don't know. You just have a different opinion than me. So let's start that over. I disagree with you on Bitcoin. You see how friendlier that is? You're categorically wrong. Right away I can stop reading and dismiss your comment, because I can tell you don't know how to structure an argument or debate. I disagree with you on Bitcoin. Let's start that. Even in the belief narrative, the conditions of Bitcoin are tied to the internet and its use case. In respect to the work you do with the CSC videos, and if you respect what is in reality the construct of capital structures fused to the technological development, well, that's not even a sentence. You start with a clause, you have a phrase, but you have no complete sentence here. I don't know what that means. I don't know how to respond to that. It's finite element. Oh, it's finite. Yeah, it's finite. It's finite. It's finite. It's the only thing coiners know how to say. It's finite, man. It's finite. So is gold. Right? It's finite element in contrast to gold ubiquity. First of all, gold is not infinite. If it were infinite, the entire universe would be gold. And that's not true. Even if the entire planet were gold, it would still be finite. Clearly, the entire planet is not gold. So that means gold is finite. The concentration of gold in ore has been dropping over the decades. Now, for every ton of ore you're bringing up, you're talking about grams of gold, not ounces of gold, but grams of gold in every ton of ore. That we haven't gotten all of the gold out of the ground yet is because the price isn't high enough. But at some point, you will run out of gold. It is finite. At some point, you'll run out of Bitcoin. Sure, it's finite. But in 50 years, you know what I'll hear? Oh, it's finite, man. In 100 years, you know what I'll hear? Oh, it's finite, man. Because we're not expected to mine the last Bitcoin to 2140. So in 100 years, it'll still... Well, first of all, in 10 years, I think Bitcoin will be relegated to hobbyists and collectors. And it'll just be a memory like BlackBerry was. Remember the BlackBerry? Oh, yeah. Bitcoin is having its Beanie Baby moment. And a Beanie Baby it is. That is my opinion. These don't make perfect sentences. Its finite element in contrast to gold ubiquity makes Bitcoin more desirable within the construct of belief, as in what is desired remains in the realm. Okay, I'm done. I'm done, coiners. And that's it.